If you work in a private company and all of a sudden you see this growth, where you're opening branches, you're buying the infrastructure, don't get excited very fast until you follow the money. And I'll tell you why. Now, when you start your own business, your own private company, whether it's in the hospitality industry or whichever other sector, there are three main ways of funding it. One is you borrow money. So you borrow money from the banks or from any other financial institution. Or you can sell part of the business, or you get money in exchange for equity. And by the way, I forgot one. You can always fund your business by savings or borrowing money from family. In fact, we put it this way: you can borrow, you can fund your business with money from family, friends, and fools. Well, my fix food. Okay, it's not a very, but it happens. It happens. There are people with money and they don't know what to do with it. So anyway, but let's focus on the first two: debt and equity. Now, when you're starting out as a business, you may not have the necessary financial history to borrow, or you may not have the necessary collateral to support such financing. And so what happens is that, and by the way, one of the ways in which you can manage this is to have a very strong board, which can help you navigate some of this. But even then, there are situations whereby you're not able to get the level of funding that you need, and so the option becomes equity. Now, there are two main bodies that are in this area, which are venture capitalists and private equity fund. Venture capitalists are individuals that fund business, private companies, and private equity funds. They are those who fund private or even public, or they get a public and then privatize. There's something I want you to understand here if you work in the private sector. This money you get from either venture capitalists or private equity funds, this is not their money. This is money they have gotten from pension funds, investment funds, and wealthy individuals, and they're investing on their behalf, meaning that when they put money in that business, they will need to get it out at some point. And so when they get into that business, their focus is on how to bring in efficiencies, how to align how to make the business lean enough so that they can make enough money so that in 10 years, after 10 years, they can be able to exit. And so the typical person thinks, when you get money from equity fund, private equity funds or venture capitalists, the general idea is that we are small, we get more money, we grow. But now the challenge is that the perspective of the private equity investors is, you are small, we institute changes, and then we exit. And so anytime you see money coming in very fast, as an employee, you need to understand that there are some changes which may affect you, because the people who put the money need to get it out. So what do you need to do? Number one, appreciate that for you to lose a job, you don't have to be incompetent or lazy. Sometimes things just happen because a company is sold, and that's it. But the most important part for you working in the private sector is to add value. They may employ you as a secretary, but you present yourself, brand yourself, present yourself as a solution provider, because even the investors who are coming from outside, they're looking for solutions. And so package yourself. Volunteer for projects, not necessarily in your department. Volunteer your ideas, not just ideas. Craft something and present it to the management, of course, through your boss. Because if you don't do this, when they are refining the business, you may end up losing your job. But they will never let go someone who adds value. Think about that. See you soon.